Imagine you're playing a video game, not just any game, a massive online game where gold coins equal real power. Every coin you collect gives you influence, control, freedom. Now imagine you discover a glitch, a hidden combination of buttons. Every time you press them, gold appears in your account. No effort, no skill, no risk. You press once, gold. You press again, more gold. You keep pressing, infinite gold. This isn't skill, this isn't strategy, it's a mechanical flaw in the system. Now imagine the game administrators discover what you're doing. They see the logs, they see the impossible trades, they see the mountain of gold that could never exist naturally. And instead of banning you, instead of deleting your account, instead of wiping the stolen wealth, they say this: give us a small cut, just a percentage, and you can keep playing. That is not a video game. That is modern finance, and this is not fiction. In the world of high finance, this is a documented historical fact. The bank was JPMorgan, the market was gold and silver, and the glitch had a name: spoofing. This documentary opens the official files on one of the largest financial crimes in history. A crime so big that most people still don't understand what actually happened. A crime so controlled that prices moved on command. A crime so protected that executives walked free. And the proof? It came straight from the U.S. Department of Justice. September 29th, 2020. That was the day the system cracked. The day JPMorgan admitted to manipulating the gold and silver markets. Not accused, not suspected, not alleged. Admitted. They paid a record $9 to $20 million penalty, the largest ever for market manipulation. And buried inside that settlement was something even more disturbing. This wasn't a one-time mistake. This wasn't a rogue trader. This wasn't an accident. According to the DOJ, this went on for 8 years. 8 years of artificial prices. 8 years of phantom supply. 8 years of pushing silver down on demand. 8 years rigged. Let's be very clear. Markets are supposed to be driven by supply-demand price discovery. But what happens when supply is fake? What happens when demand is crushed by orders that were never meant to exist? What happens when algorithms can flood a market with imaginary metal? You don't get a free market, you get a controlled one. What spoofing really is, without the Wall Street spin. Spoofing is simple and devastating. A trader places massive buy or sell orders with no intention of executing them. These orders appear real, appear large, appear urgent. Algorithms and other traders react. Prices move. And then, before execution, the orders are canceled. They were never meant to be filled. They existed only to move price. Now imagine doing this not once, not twice, but thousands of times across years using high-speed algorithms. This is what the DOJ called a scheme to defraud the precious metals markets. Phantom silver, selling what doesn't exist. Here's where it gets darker. In the silver market, contracts represent huge quantities of metal. By flooding the market with sell orders, JPMorgan traders created the illusion of massive supply. But that supply didn't exist. No physical silver moved, no bars were delivered, no vaults were emptied. It was phantom silver. And when supply looks endless, price collapses, on command. This is why silver would crash. During low liquidity hours, overnight. In seconds, with no news. With no economic reason? Retail investors would panic. Stop losses would trigger. Prices would cascade lower. And the same bank that pushed the price down would buy at the bottom. The machine was not human. This wasn't emotion. This wasn't fear. This wasn't greed alone. This was automated. High-speed trading algorithms were used to layer orders, cancel instantly, repeat endlessly. The DOJ confirmed this behavior in official filings. Internal chat logs showed traders joking about it, boasting about it, teaching others how to do it. This wasn't hidden. It was normalized. Cost of doing business. Here's the most chilling part. $920 million sounds like a lot, until you realize what it represents. Not prison, not personal accountability, not executive handcuffs, just a payment. A deferred prosecution agreement, a legal loophole where the company pays, the individuals walk, the system continues. The DOJ literally allowed JPMorgan to avoid criminal prosecution, as long as they promised to behave. After 8 years of manipulation, this is why people call it the infinite money glitch. If you steal billions and pay millions, that's not a punishment, that's a business expense. Why this matters? Right now, this story isn't history, it's a warning, because silver today still trades in a system built on paper contracts, leverage, trust, a system where a few players dominate volume, a system where price does not equal reality, a system where physical metal and paper metal are not the same thing. And once trust breaks, the price doesn't slowly adjust, it snaps. What you're about to see in this documentary is not opinion. It's not theory. It's not conspiracy. It's official court evidence, internal messages, DOJ reports, trader confessions. And once you understand how this worked, you will never look at silver or markets the same way again. Inside the scheme, how JPMorgan controlled silver prices in real time. To understand the scale of what happened, you have to forget everything you've been told about how markets work, because what occurred inside the precious metals market was not trading, it was engineering. The illusion of a free market. Most people believe silver prices move because investors buy, miners sell, demand rises, supply tightens. That belief collapses when you look at the actual structure of the market. The silver market is not primarily physical, it is paper-based. For every single ounce of real silver, there are dozens, sometimes hundreds of paper claims. Futures contracts, options, swaps, unallocated accounts. These are promises, not metal. And whoever controls the paper controls the price. JPMorgan's strategic position. By the early 2010s, JPMorgan wasn't just another participant. They were the participant. They were one of the largest bullion banks in the world. A dominant market maker, deeply embedded in COMEX operations, custodian of massive silver vaults. They could see the order book. They could see liquidity. They could see where stops were clustered. Retail traders were blind. JPMorgan wasn't. How price was crashed on command. According to DOJ findings, the method was consistent and repeatable. Here's how it worked. A trader would place enormous sell orders, far larger than normal market activity. These orders were designed to appear urgent, appear aggressive, appear real. The market reacted instantly. Algorithms detected supply. Other traders backed away. Prices dropped. Then, milliseconds later, the orders vanished, canceled, never executed. But the damage was already done. Price had moved, and JPMorgan profited from the move they created. Why silver was the perfect target. Silver is uniquely vulnerable. It has lower liquidity than gold, fewer large participants, heavy retail interest, high leverage. That means small pressure can cause large moves, especially during Asian trading hours, overnight sessions, thin liquidity windows. This is why silver crashes often happened when Western markets were closed, volume was minimal, news was absent. Natural markets don't behave like that. Engineered ones do. Spoofing was standard practice. This wasn't hidden in backrooms. DOJ transcripts revealed traders openly discussed spoofing. They joked about it. They trained junior traders how to do it. They even had internal language for it. This wasn't rogue behavior. It was institutional culture. One trader described spoofing as part of the job. Another openly admitted to manipulating prices to trigger stop losses. These weren't accusations. These were confessions. Triggering the cascade. The real power wasn't just moving price. It was triggering reactions. Once price moved, stop losses activated, margin calls followed, forced selling occurred. The initial spoof was just the spark. The cascade did the rest. This is why silver could fall sharply in seconds with no news. The market wasn't reacting to reality, it was reacting to illusion. The phantom supply problem. One of the most dangerous aspects was artificial supply creation. Paper silver can be created infinitely. Physical silver cannot, but price is set by the paper market. So when JPMorgan flooded the market with sell orders representing millions of ounces, it didn't matter if those ounces existed. Price treated them as real. This broke the natural link between mining output, physical demand, market price. Silver became disconnected from reality. Why regulators didn't stop it. This is where the story gets uncomfortable. Regulators weren't ignorant. They had complaints, data red flags. But JPMorgan wasn't just another bank. It was systemically important, too big to fail, too connected to punish easily. Investigations moved slowly. Years passed, and the manipulation continued. 8 years, not 8 days. The DOJ confirmed this scheme ran from at least 2008 to 2016. Think about that. 8 years of distorted prices. 8 years of investors buying and selling based on false signals. 8 years of miners underpaid. 8 years of suppressed price discovery. This wasn't a glitch anymore. It was a feature. The psychological impact on investors, retail investors, were blamed. You bought the top. You panicked. You misread the market. But the market itself was lying. People weren't wrong. The system was. Every crash taught investors fear. Every rally was capped. Confidence eroded. Silver became known as the metal that never moves. That reputation was engineered. How JPMorgan benefited. Beyond trading. This wasn't just about trading profits. suppressed silver prices, benefited industrial users, protected fiat perception, reduced inflation signals. Silver rising sends a message. It signals currency weakness. It signals inflation. It signals loss of control. Keeping silver quiet mattered. Internal evidence sealed the case. The DOJ case wasn't built on theory. It was built on recorded chats, order logs, trader testimony. Traders admitted intent. They admitted coordination. They admitted repetition. This wasn't accidental. It was deliberate. Yet, no executives in handcuffs. Despite overwhelming evidence, no senior executives went to prison. A few traders were charged. The institution paid the fine. The structure survived. The message was clear. Manipulation at scale is manageable, as long as you're big enough. The real cost was hidden. The $920 million fine made headlines, but it didn't account for lost investor trust, distorted price signals, damaged market integrity. Those costs don't show up on balance sheets, but they matter more than money. Why this still matters today? Because the system hasn't fundamentally changed. Paper still dominates. Leverage still exists. Transparency is still limited. And when trust breaks, markets don't adjust gently. They reprice violently. This wasn't just about silver. It was about control, about power, about who decides what something is worth. And once you understand how this was done, you begin to ask a far more dangerous question. What else is priced this way? The cover, the collapse, and the illusion of justice. Every major financial crime has two phases. The first is the crime itself. The second is how the system responds when the crime becomes impossible to hide. What happened after JPMorgan's manipulation was exposed is just as important as the manipulation itself, because this is where the real story reveals itself, when the data became too loud to ignore. For years, complaints about silver manipulation were dismissed as conspiracy. Retail investors were mocked, analysts were sidelined, whistleblowers were ignored. But the data kept piling up. Patterns emerged that could not exist in a free market. Massive sell orders appearing instantly, price collapses and low liquidity, immediate cancellations after price impact, repeated behavior by the same institution. Eventually, even regulators could no longer look away. The manipulation wasn't subtle anymore. It was mathematical. The DOJ steps in, quietly. The Department of Justice didn't act publicly at first. They moved silently. Subpoenas, trade logs, internal communications. What they found wasn't a single bad actor. It was a system, a repeatable, teachable method embedded inside a major bank. The evidence was overwhelming. Traders didn't just break rules. They bragged. One of the most damning aspects of the case was not the trades themselves, it was the conversations. Internal chat logs revealed traders openly discussing spoofing strategies. They talked about how to move price, how to avoid detection, how to trigger stops, how to paint the tape. They joked about it. They laughed about it. This wasn't pressure-induced behavior. It was confidence. The confidence of people who believed they were untouchable. Intent. The line that was crossed in financial law. Intent is everything. Markets can move accidentally. Orders can be placed in error. But spoofing requires intent. And the DOJ had it in writing. Traders admitted they placed orders they never intended to execute. They admitted the goal was to deceive other market participants. They admitted repetition. That alone destroyed any defense. The deferred prosecution agreement. Explained when the settlement was announced, most people focused on the number. $920 million. It sounded historic. But the structure of the deal mattered more than the size. A deferred prosecution agreement means the company avoids criminal charges. The company pays a fine. The company promises reform. The company continues operating. No trial. No public cross-examination. No executive accountability. The institution survives intact. Why this wasn't true justice? Imagine any other crime that lasted 8 years. Imagine the damage. Imagine the victims. Now imagine the perpetrators paying a fraction of the gains and walking free. That's not deterrence. That's permission. The message was clear. If you're large enough, punishment is negotiable. The traders took the fall. Conveniently, several individual traders were charged. They became the face of the scandal. But they were not the architects. They operated within a system that rewarded manipulation, encouraged aggressive tactics, measured success by profit alone. Culture doesn't come from junior traders. It comes from the top. Yet the top remained untouched. The public narrative was carefully managed media headlines focused on bad apples, isolated misconduct, lessons learned. The deeper implications were avoided because admitting the truth would raise dangerous questions about market integrity, about price discovery, about trust itself. The story was contained, controlled, just like the market had been. What investors never got back. The settlement didn't compensate. Retail investors, long-term holders, miners harmed by suppressed prices. There was no restitution, no recalculation, no correction. The market simply moved on, but damage like that doesn't disappear. It accumulates. The psychological aftermath. Silver investors learned a painful lesson, not about risk, but about power. They learned that fundamentals don't matter if price is controlled. They learned that patience doesn't matter if rules are uneven. They learned that the game is not fair. That kind of realization changes behavior. It destroys trust. Why silver stayed suppressed, even after exposure. Many expected prices to explode after the case. They didn't, because exposure alone doesn't dismantle a structure. The paper market still dominates. Leverage still exists. Big players still control liquidity. One case didn't reset the system. It merely exposed a crack. The difference between legal and legitimate. Something can be legal and still be wrong. Deferred prosecution agreements are legal. High-frequency trading is legal. Paper leverage is legal. But legitimacy comes from fairness, and fairness was absent. The illusion of reform. After the settlement, JPMorgan promised changes, compliance upgrades, training programs, monitoring systems. But the core incentive structure remained. Profit still ruled. Speed still mattered. Scale still protected. Reform without structural change is theater. Why this case matters. Beyond silver, this wasn't about one metal. It was about a model where price is divorced from reality. Paper overwhelms physical, trust is assumed, not earned. Silver just happened to be vulnerable enough to reveal it. The silent question. Regulators avoid. If this happened in silver, where else did it happen? Gold, rates, currencies, equities? The question is uncomfortable, because answering it honestly would challenge the foundation of modern markets. The cost of silence. Most people moved on. Markets always do. But silence is not neutrality. It's acceptance. And acceptance guarantees repetition. What this case proved beyond doubt. It proved that markets can be engineered, prices can be controlled, crimes can be absorbed. Accountability can be deferred. And most importantly, it proved that truth does not automatically lead to change. The system didn't break, it adapted. That's the most dangerous part. The system survived, which means it learned, and systems that learn from exposure don't stop. They evolve. The line between stability and fragility. Controlled systems appear stable until they aren't. They suppress signals, they delay adjustment, they store pressure, and when pressure finally escapes, it doesn't whisper, it explodes. This wasn't just a scandal, it was a warning. A demonstration of what happens when power replaces transparency, when scale replaces accountability, when profit replaces trust. The endgame. What the JPMorgan silver case really reveals about the system. Every story like this ends the same way in the public imagination. The crime is exposed, the evidence is revealed, the fine is paid, and the chapter closes. But that ending is an illusion. Because the JPMorgan silver case was never about silver alone. It was about how modern markets truly function. And what happens when power becomes invisible. This final part is not about what happened. It's about what it means. The false comfort of it's over. After the settlement, many people believed the manipulation era had ended. The logic sounded reasonable. The crime was exposed. The fine was historic. The regulators acted. But systems don't change because of embarrassment. They change because incentives change. And in this case, the incentives remained intact. Paper silver versus physical reality. To understand the endgame, you must confront the central contradiction of the silver market. Silver is finite. You must mine it, refine it, transport it, store it. It takes time, it takes capital, it takes energy. Paper silver requires none of that. A contract can be created instantly. Unlimited leverage can exist without a single ounce moving. And as long as price is discovered in the paper market, physical reality is secondary. That is the core vulnerability. Why price didn't explode after the case. Many expected silver to skyrocket once manipulation was admitted. It didn't, and that confused people. But exposure does not equal dismantling. The same structure remained. Futures dominance, high leverage, cash settlement preference, opaque inventory reporting. The machine wasn't destroyed, it was exposed and then reinforced. The role of trust in financial systems. Every financial system runs on one invisible asset, trust. Not money, not metal, not contracts. Trust. Trust that prices reflect reality. Trust that rules apply equally. Trust that markets are not scripted. The JPMorgan case damaged that trust permanently, even among professionals. Why retail investors were never the priority. Retail investors believed regulators existed to protect them. The case revealed something harsher. Regulators protect system stability, institutional continuity, market confidence. Retail protection is secondary, because the collapse of a major institution is seen as more dangerous than the erosion of fairness. That philosophy shaped every decision. Stability over truth. The DOJ faced a dilemma: prosecute aggressively and risk destabilizing a systemically important bank, or settle quietly and preserve the structure. They chose stability. That choice defined the outcome. The myth of free markets. Free markets require equal information, equal access, equal enforcement. None of those existed here. JPMorgan had superior data, faster execution, regulatory insulation. That is not a free market. That is a managed one. Silver as a signal suppressor. Silver is more than an industrial metal. Historically, it has been a monetary metal, an inflation signal, a confidence barometer. Rising silver prices send a message. They suggest currency debasement. They suggest systemic stress. Keeping silver subdued wasn't just profitable. It was strategic. The illusion of infinite liquidity. Paper markets create the appearance of endless liquidity, but physical markets cannot. This mismatch creates fragility. When confidence exists, paper and physical coexist. When confidence breaks, paper claims race toward physical limits. That's when systems fail. Why this case still isn't priced in. Markets price information, not implications. The information is known. JPMorgan manipulated silver. The DOJ proved it. The fine was paid, but the implications are ignored, because pricing them would require admitting structural fragility, systemic imbalance, trust erosion. Markets don't like existential questions. The silent buildup of pressure. Suppressed systems don't release pressure gradually, they accumulate it. Every artificially capped move adds tension. Every distorted signal delays adjustment. Eventually, adjustment becomes violent, not because of emotion, but because of physics. Physical demand versus paper control around the world. Industrial demand grows, investment demand grows. Supply struggles to expand, yet price often disconnects. That contradiction cannot persist forever. Either physical adapts to paper, or paper is forced to adapt to physical. History suggests the latter always wins, eventually. Why confidence is the real risk. The greatest risk is not price volatility, it's confidence collapse. When participants stop believing in fair settlement, honest pricing. Reliable delivery markets don't function. They seize, lessons. The system hopes you don't learn. This case teaches uncomfortable truths. Markets can be engineered for long periods. Regulation often reacts. Late, penalties can be absorbed. Accountability is negotiable. Transparency is selective. Once you understand that, you stop asking naive questions and start asking dangerous ones. The difference between exposure and resolution. Exposure reveals. Resolution reforms. This case achieved exposure. It did not achieve resolution. The structure survived. The incentives survived. Only the narrative changed. Why never again is rarely true. After every scandal, reforms are promised. And after every reform, loopholes appear, because complexity favors those who design it. And modern finance is built on complexity. The end game is not a date. It's a condition. People often ask, when will it break? That's the wrong question. Systems don't break on schedules. They break when trust evaporates. Physical limits assert themselves. Participants act simultaneously. The end game is not a moment. It's a condition. Why silver still matters more than people think. Silver sits at the intersection of money, industry, energy, technology. It cannot be replaced easily. It cannot be created digitally. And it cannot be faked forever. That makes it dangerous to control and impossible to ignore indefinitely. What the JPMorgan case ultimately proved that. The market was not broken accidentally. It was structured that way, and it was defended that way. That realization changes how you see everything else. The quiet shift already underway. You won't see this on headlines, but behavior is changing. Physical accumulation increases. Long-term trust declines. Paper skepticism grows. These shifts happen silently until they don't. The final illusion. The biggest illusion is believing this story has an ending. It doesn't. It has consequences. And consequences don't ask permission. Closing reflection. The JPMorgan silver case was not an anomaly. It was a window, a rare moment where the curtain lifted and the mechanics were visible. For those who saw it clearly, nothing looks the same again. Not prices, not markets, not authority, not assurances. And once that understanding sets in, you stop waiting for confirmation, because the proof already happened.